Imagine waking up one morning to headlines suggesting that the single financial arrangement holding the global economy together for nearly half a century has quietly cracked, not with an explosion, but with a signature, a policy shift, and a silence so loud it rattles markets from New York to Shanghai, because if Saudi Arabia truly steps away from the petrodollar system, the ripple effect isn't just about oil or dollars, it's about a $7 trillion shock that could reshape currencies, gold, debt, and power itself in ways most people aren't prepared for. For decades, the petrodollar has been one of those invisible pillars you never really think about unless it starts to wobble, and to understand why today's news matters, we have to rewind to the early 1970s, when the United States and Saudi Arabia struck a deal that quietly rewired the global financial system. After the dollar was severed from gold in 1971, America needed a new way to ensure global demand for its currency, and Saudi Arabia needed security, weapons, and guaranteed support in a volatile region. The agreement was simple but brilliant. Saudi oil would be sold exclusively in US dollars, and in return, the US would provide military protection and political backing. Once the world's largest oil exporter priced crude in dollars, every country needing energy had to earn, buy, or borrow dollars, effectively forcing global demand for the US currency regardless of America's trade deficits. This system didn't just support the dollar, it allowed the US to run massive deficits, finance wars, expand financial markets, and export inflation without immediate consequences, because dollars kept flowing back into US Treasury bonds and assets as oil revenues were recycled through American banks. Over time, this arrangement grew far beyond Saudi Arabia. OPEC followed. Oil futures markets were priced in dollars, and the dollar became the dominant reserve currency, accounting for roughly 60% of global reserves for most of the past several decades. This dominance lowered borrowing costs for the US government, stabilized demand for Treasury bonds, and gave Washington enormous geopolitical leverage through sanctions, access to dollar clearing, and control over global financial plumbing. The petrodollar wasn't just about oil, it was about power. But systems built on trust and alignment don't last forever, especially when the underlying incentives begin to shift. Fast forward to the present, and cracks have been forming for years. The US weaponization of the dollar through sanctions, freezing reserves, and cutting countries off from SWIFT sent a clear message to the world. The dollar is powerful, but it can also be used against you. For countries like China, Russia, Iran, and even longtime US partners who value strategic autonomy, this raised an uncomfortable question. What happens if access to the dollar becomes a liability rather than a benefit? At the same time, the global balance of power has been shifting eastward. China became Saudi Arabia's largest oil customer, surpassing the US, while Asia now consumes the majority of Gulf energy exports. When your biggest customer pays in yuan, not dollars, insisting on dollar-only pricing starts to feel less like stability and more like friction. This is where the recent official narrative comes in, and it's important to be precise. Saudi Arabia has not announced a dramatic press conference declaration that the petrodollar is dead. Instead, what has changed is more subtle and, in many ways, more powerful. Saudi officials have signaled openness to accepting multiple currencies for oil sales, including the Chinese yuan, and have joined or engaged with institutions and forums that promote non-dollar trade settlement. Reports about long-standing bilateral arrangements expiring or not being renewed have fueled headlines, but the real shift is behavioral rather than ceremonial. Saudi Arabia is diversifying its options, not burning bridges, and in finance, optionality is everything. To grasp why this matters, think of the petrodollar like gravity in a solar system. You don't see it, but it keeps everything orbiting smoothly. If that gravity weakens even slightly, planets don't immediately fly away, but their orbits start to wobble. When oil can be priced in yuan, euros, or a basket of currencies, global demand for dollars doesn't vanish overnight, but it no longer grows automatically with energy consumption. Countries importing oil can settle trades without holding as many dollars, central banks can diversify reserves, and surplus nations don't have to recycle every energy dollar back into US assets. Over time, this reduces the structural bid under the dollar and increases competition among currencies for reserve status. Now layer in the numbers. Global oil trade is measured in trillions of dollars annually, and the broader energy complex influences everything from shipping to fertilizers to manufacturing costs. When analysts talk about a $7 trillion shock, they're not saying $7 trillion disappears tomorrow. They're pointing to the scale of financial flows tied directly or indirectly to dollar-priced energy, US Treasury recycling, and derivative markets built on that foundation. If even a portion of those flows shifts into other currencies or assets, the impact on bond yields, exchange rates, and capital markets could be profound. Higher U.S. borrowing costs, a weaker dollar over time, and increased volatility become more likely, not guaranteed but possible in a way they weren't before. This is also where precious metals enter the conversation, because throughout history, whenever confidence in paper systems wavers, gold and silver reassert their role as neutral apolitical money. Gold doesn't depend on a trade agreement, a central bank, or a military alliance. It doesn't carry counterparty risk. Central banks understand this better than anyone, which is why global official gold purchases have surged in recent years, particularly among non-Western nations seeking to balance their reserves away from dollars. Think of gold as financial bedrock. When the structure above it shifts, that bedrock suddenly looks very attractive again. Silver, often called gold's volatile cousin, plays a dual role as both monetary metal and industrial input, making it sensitive to both financial stress and energy-driven industrial demand. Critics argue that the petrodollar's end has been predicted many times before, and that the dollar remains dominant because there is no true alternative with comparable liquidity, transparency, and rule of law. That argument isn't wrong, but it misses the point. Reserve currency transitions don't happen in dramatic collapses, they happen in slow reallocations. The British pound didn't lose its status overnight, it faded as trade patterns, debt burdens, and geopolitical power shifted. The dollar can remain dominant while still becoming less dominant, and that distinction matters enormously for markets. Saudi Arabia's motivations are also pragmatic rather than ideological. Vision 2030 requires massive foreign investment, diversified partnerships, and flexibility. By signaling currency openness, Saudi Arabia strengthens ties with China, hedges geopolitical risk, and increases its negotiating power with all partners, including the US. This isn't a rejection of America, it's a recalibration in a multipolar world. But every recalibration sends signals, and markets are built on signals. For everyday investors and viewers, the key question isn't whether the petrodollar is officially dead, but whether the forces that supported it are weakening. When energy trade becomes more fragmented in currency terms, when central banks accumulate gold at record pace, and when major exporters seek settlement outside the dollar, the long-term implications point toward a more inflation-prone, volatile, and asset-focused world. In such a world, understanding money, metals, and macro trends isn't optional, it's survival literacy. And all of this brings us to the critical point we need to explore next, because the real consequences of this shift won't show up in headlines first, they'll show up in bond markets, currency charts, and the quiet repositioning of capital happening right now. Now we have to zoom in on where this shift actually touches the real financial system. Because geopolitical announcements only matter if they change behavior, and behavior shows up first in markets that most people never watch closely. One of the earliest places to look is the U.S. Treasury market, often described as the deepest and safest pool of capital on Earth. For decades, petrodollar recycling meant that oil-exporting nations accumulated vast dollar surpluses and parked them in treasuries effectively, funding U.S. deficits at lower interest rates than would otherwise be possible. This steady demand acted like a shock absorber, keeping yields contained even as U.S. debt ballooned past levels that would normally worry investors. Today, U.S. federal debt has surpassed $34 trillion, and annual deficits routinely run in the trillions. As long as global demand for dollars kept pace, the system held. But when surplus nations diversify away from treasuries, even gradually the math begins to change. Less automatic demand means the U.S. Treasury must attract buyers the old-fashioned way, by offering higher yields, and higher yields ripple through the entire economy, from mortgage rates to corporate borrowing costs. You can think of this like a credit card with a very low interest rate that suddenly resets upward. The balance doesn't disappear, but servicing it becomes more expensive, and that expense compounds over time. This is why bond markets react so sensitively to shifts in global reserve behavior. Even small reallocations can move yields because of the sheer scale involved. When analysts warn about a $7 trillion shock, they're pointing to the cumulative impact of altered flows across treasuries, currencies, derivatives, and commodities, not a single event. Currency markets tell a similar story. The dollar's strength over the past decade has been supported not just by U.S. economic performance, but by its role as the default settlement currency for energy, trade, and global finance. When oil contracts can be settled in yuan or other currencies, importers no longer need to hold as many dollars on hand. Central banks managing reserves can justify holding a broader basket, reducing their exposure to U.S. policy decisions. Over time, this can weaken the dollar's exchange rate, making imports more expensive for Americans, while boosting export competitiveness. A weaker dollar isn't inherently bad, but combined with high debt and structural deficits, it can fuel inflationary pressures that are hard to control. Inflation, in this context, isn't just about prices rising at the grocery store. It's about the purchasing power of money eroding because the supply of currency grows faster than real goods and services. When global demand for dollars softens, the U.S. loses some ability to export inflation abroad. Historically, excess dollars could flow overseas, absorbed by trade and reserves. In a more multipolar currency world, those dollars stay closer to home, bidding up assets and consumer prices. This is one reason why tangible assets, especially precious metals, regain attention during periods of monetary transition. Gold, often dismissed during stable times as a relic, thrives in uncertainty precisely because it sits outside the political system. It has no issuer risk, no default risk, and no allegiance. When central banks in Asia and the Middle East accumulate gold, they're not betting against the US in a dramatic sense, they're hedging against concentration risk. It's portfolio management at a sovereign scale. Silver, while more volatile, benefits from similar dynamics but with an added twist. Its heavy use in electronics, solar panels, and industrial processes ties it directly to energy transitions and infrastructure investment. If the world is moving toward new energy systems while old financial structures shift, silver sits at the crossroads of both trends. Another layer often overlooked is the derivatives market, oil future, EES. Currency swaps and interest rate derivatives are priced and collateralized largely in dollars. When settlement currencies diversify, these markets must adapt, increasing complexity and, potentially, systemic risk. Complexity isn't inherently dangerous, but it raises the cost of mistakes. The 2008 financial crisis taught us that interconnected systems can transmit stress rapidly when assumptions break. A gradual erosion of dollar dominance doesn't cause a crisis by itself, but it changes assumptions that trillions of dollars in contracts are built upon. We also have to consider the political economy angle. Saudi Arabia's move toward currency flexibility strengthens its bargaining position with all partners. It can negotiate energy deals that align with long-term investment goals, technology transfers, and infrastructure development. China, for its part, gains incremental support for internationalizing the yuan, even if it remains far from replacing the dollar outright. The yuan doesn't need to become the dominant reserve currency to matter, it just needs to become useful enough to reduce friction in trade. Think of it like adding alternative routes to a highway system. Traffic doesn't abandon the main road immediately, but congestion eases and reliance on a single path diminishes. For the US, the challenge is strategic adaptation. Dollar dominance has allowed policy flexibility that few nations enjoy, but it can also breed complacency. Structural reforms, fiscal discipline, and investment in productive capacity matter more in a world where privilege erodes. The end of automatic demand forces accountability. Historically, empires that recognized this early adapted, those that ignored it struggled. This isn't about collapse narratives, it's about transition dynamics. From an investor's perspective, transitions create both risk and opportunity. Volatility increases, correlations change, and assets once considered boring suddenly move. Bonds, for example, may no longer provide the same ballast they did in a falling equity market if inflation expectations rise. Commodities regain relevance as stores of value and inputs to real economic activity. Diversification stops being a buzzword and becomes a necessity. Asking simple questions becomes powerful. What backs this asset? Who controls its supply? And how does it behave when trust shifts? All of this sets the stage for the most important discussion of all, because beyond markets and metals, there is a deeper question about confidence itself. Money is ultimately a social agreement, reinforced by habit, power, and belief. When those beliefs adjust, even slightly, the effects cascade. To understand where this leads next, we need to examine historical parallels in future scenarios, because the path from here is not linear, and the choices made in the coming years will determine whether this shift is remembered as a smooth evolution or a painful reckoning.